Welcome back to Hurley in the Morning. Kirk Conover sitting in for Harry. You're listening to WPG Talk Radio 1450 AM. And our next segment, the following program segment, is paid for by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck Malamut and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Welcome, Chuck, to Hurley in the Morning with Hurley's humble servant, Kirk.
Good morning, Kirk. Good morning,
co-piloting
Al.
here.
You guys are doing a fabulous job. I know it's really tough.
After reading all that, we're out of time. I'm sorry, Chuck.
It's really tough to take over for the man. But usually when Harry goes away, I have a tendency to kind of say some things that I won't say to his face, only because fear of retaliation potentially. But I think today I'm gonna step aside because Harry's having a really, really tough time with his night job, which is selecting football over the weekend. So we're gonna kind of leave it at that, and we're just gonna say that as I always say, if you're not in first place, you're in last place. And Harry certainly is not in first place. So I hope he's enjoying himself. He needs a much-needed vacation. And I'm sure he'll come back here. He'll be all fired up.
He'll be fired up for you after that football.
He'll be fired up. He'll be fired up all the time for everybody. And kudos to Ken Mosca, you. I think Paul Rotella comes at the end of the week. Is that correct?
Friday, I think.
So you have a number of guests, and I will tell you, doing this, I think I did it on 2 occasions. It is a lot of work. I don't think the listeners really understand the amount of prep work that a guest host has to do to be obviously well prepared to keep the show going, because it's easy to really flip the station and go to another venue with everything that's out there today. So fine job this morning. We won't talk about politics. You can get to that at 8:45.
That's fine.
We're going to talk about what goes on in the world, and that's unfortunately, as it turns out, capitalism.
Well, my wheelhouse is economics, so I think we're well matched.
So if you take a look at what is happening here in the equity markets, if you went away and you came back, you went on a long extended vacation, and now you're coming back, to finish up the year. And realizing that the Dow is flirting, on a daily basis, positive or negative. S&P up ever so slightly. The NASDAQ, the best of the group, at least here domestically. Everything that's happened with in the Chinese equity markets, and you would say to yourself, well, geez, we haven't gotten anything accomplished, and we've had a fair amount of anxiety, as exhibited in that just awful day that we had August the 24th, where I remember sitting at my desk and watching Dow futures, down about 125, and in a matter of just a blink, down 500, 700, 1,000 points. And, I mean,
was it down 1,000 points within 2-3 minutes of opening?
And I think a lot of that is attributed to obviously a lot of
flash trading,
program trading, computer-driven, momentum-type trades, and it's kind of it's like trying to get out of the way of a runaway freight train, and that's where you really test, your abilities, not only as an advisor but also as a client, an investor, because if you have the mindset to say, look, this is a temporary item that we're dealing with, and we've dealt with them over the last. This has almost been 30 years. That every so often something is going to happen that is that is unexpected, and ultimately, that's where investors sometimes make some very, very poor judgments. And it's the most amazing thing that I can't quite understand. Retail buyers consumers, which is obviously very important to the economy today, wait for the big sales. Whether it's pre-Black Friday, Black Friday, whatever it may be, they have to get 20, 30, 40% off. Forget the fact that the piece of apparel or whatever they're buying has been marked up. Putting that aside for a minute. But in our world,
a discount's not wanted.
Absolutely, the opposite happens.
Right.
I mean, the average investor, thrives on buying when assets, unfortunately, sometimes are overpriced, and then ultimately, I mean, if you liked an equity at $100 a share, whatever it may be, and now it's and all the fundamentals of the company are the same, and maybe they missed their earnings once or twice. Is it really so bad to what's wrong with this equity position at 70 or 75? But just the opposite happens. I need to get out. I need to get out now. I don't need to own this anymore. And probably the second most attribute that an investor has, which is I'm going to call on the poor checklist, is the fact that I'm going to wait to get even. In a position, you bought a position, you're down 20% for whatever reason, and you're going to wait to get even.
Yeah, they should be dollar cost.
Well,
averaging.
If you like the position, you can continue to buy it. If you don't like, if the stock really went the wrong way, or maybe it's
for a good reason,
the company, the industry,
right.
The market, something. Maybe it's time to fish and cut bait, and move and take that capital and do something more constructive with it.
But what you're saying is, just if the company hasn't changed and it's just sort of like the momentum of the general market. Buy as it goes down.
You should, but
yeah,
but
that's hard to do.
It is because
the psychology is hard.
It really tests your inner workings to say, okay, I'm going to step up to the plate and I'm going to really go ahead and double up on my position. But it's like anything else.
They look at it as a harbinger of bad news rather than a second chance.
Yeah, and I think unfortunately what happens is that. You have specialists, whether it's you have physician, and within that industry, you have either a gastroenterologist or a radiologist, or you have specialists within industries, and the same thing in the law world. But and I think in our world, oftentimes because of technology, a lot of individual investors think that they have the tools. Because they can go onto a computer program, they can log in and create their asset allocation model. They don't have the experience. And unfortunately, as it turns out, they oftentimes make some really, really poor judgments and decisions, which ultimately, can create, financial disaster. I just sit back and think about that because in doing this as long as we have done it, and it's not just me, it's our team. We have over 100 years of experience. So we've been through these battles. And in any case, enough of the advertisement. Let's talk about what's going on in the world.
Now, that August day of infamy, so to speak, created a situation where the Dow did dip below 16,000 briefly.
It did.
And now it's back 17,700 some.
Well,
are we going to get back over 18,000 soon?
Look, I'm not going to. Yeah, I think we will before the end of the year. And I think what investors have a tendency to do, they focus on an index because everybody knows about the Dow.
It's easier to understand.
30 stocks, market capitalization. I mean, the problem with any index is the fact that oftentimes they make replacements. They'll pull a stock out. They'll put a stock in,
which is arbitrary.
And it's based on the findings of a third party. I think the S&P 500, again, a market capitalization type index, is really what we should all be following. But the bottom line at the end of the day, our strategists have called out for the S&P to be well within that 2,200 range before we get to year end. So we're about 2,070 going in today. Today doesn't look like a terribly great day. Yesterday was just one of the worst days we've had in a long time. But you think about from that August low, and then we retest in September. because that's what we were waiting for.
Right. You had the turbulence in between.
You did, and had a fair amount of anxiety, and the technicians were calling out for that double bottom.
Right.
And they did get it. They got very, very close. And ever since then, if you take a look at the month of October, I believe the S&P was up over 9.5%.
And that usually doesn't happen in October.
October is not
a good month historically.
And so you have to the old adage, sell in May and go away. You can't live by that. I think what's really important at the end of the day is to clearly understand your goals. And it's like anything else. Like if you're going to play football, you're going to train. If you're going to be a gymnast, you're going to train, and you have set goals for yourself. In whatever those sports may be. The same thing holds true in what we do. Interestingly enough, we had a meeting with a client yesterday afternoon, and the concern was, well, what happens if the rate of return that you're projecting, we do not exceed it? And we said, okay, fine. I said, let's take a step back. And then, we engaged in a discussion, said, okay, what do you think the rate of return would be in your portfolio, assuming an asset allocation of moderate risk, 60% equities, 35% fixed, 10% cash. So we reran the number based on their thought process, which I thought was extremely low as far as a potential rate of return. And lo and behold, at the end of the day, yes, there's less money that you have that the next of kin will inherit, so to speak, but you're still going to be able to get everything accomplished that you wanted to during your retirement. And I think because we're just so busy all day long in our daily lives, we oftentimes do not take a step back to truly understand what's important and what's not.
Well, you're building a financial foundation for people's retirement.
Absolutely, and I think
and people should understand this is not trading stocks to trade stocks for profit. This is not going on margin. This is investing in companies and assets and letting them work.
And just because you buy a position on Tuesday at 9:30 at the open and it's $30 or whatever it may be, there's really no reason why that position should be slightly higher, slightly lower that afternoon. But
it's just the way it is.
But the goal is that if we go back and we look, I mean, like I said, as you know, we've been doing this a long time. Mm-hmm. We have seen tremendous growth by being patient in what we own. And I think that's very, very important.
And that is hard for most people.
It is extremely challenging. It's because there is this station that is referred to as constant negative business cycle that's out there. And what their goal and what the goal of any television station, and actually radio is to get television for sure to get your eyeball the next commercial.
If it bleeds, it leads.
Yeah, it does. So, Al, are we going to break?
Yes.
So why don't we step aside for a second,
Sure.
if that's okay,
Yep.
and we'll get the much needed advertisements in, and then we'll come back.
Very good. Cash flow. Welcome back to Hurley in the Morning. We are now on the air with Chuck Malamut, his weekly program. Chuck, the jobs report came out Friday. More jobs created than expected. Unemployment, the reported unemployment rate goes down to 5%. There are those of us in the economics community that do not consider that a valid unemployment rate measurement. It's done by a survey of 60,000 households instead of real numbers, which the real unemployment rate's 9.8, and it didn't change.
Kirk,
how'd the market react?
Good point. I mean, first of all, yeah, as you mentioned, 271,000 was a job print for the month of October, and it was significantly higher than everyone had anticipated. not only that, the prior months were also adjusted higher. So a couple things we come out of the report. As you mentioned, 5% unemployment. And what really is, what is the real unemployment number? I think it's probably closer to 15 to 18%. But the good news out of the report was the fact that the year-over-year wages increased about 2.5%. And that is extremely important with respect to the consumer, because as Harry and I, we always chat about, the economy is like a three-legged stool, and the consumer is, happens to be one of those legs. And without the consumer, it becomes very, very challenging. I mean, as we mentioned on the break, the 2% being the new norm as far as, GDP. Imagine if the consumer did not spend, where we would be. So the other thing that happened was that the September report that we had might have been an aberration. And, we as a country now remain somewhat on an upward bias with respect to growth. And it's anybody's guess, where we get to before the end of the year. Because I don't think the 5% is really a 5% number. You have a number of people that want to be gainfully employed, and because of the job market where it is, and unfortunately this area just being very, very tough and challenging, working multiple part-time jobs. And I'm guessing that they're counted multiple times.
Well, no, they're counted in what's called the underemployment rate.
Okay.
That they're underemployed because they have two part-time jobs instead of one full-time. That's the 9.8%. So those people are considered unemployed because they're not doing what they should be doing full-time.
Right.
In other words, if you have a certain skill set and you're laid off, and then you go and you do something that's sort of below your training, you're considered underemployed. And you don't have the purchasing power. You don't have the time to do a lot of things that you should be doing to help the economy. But back to your point about the 2% growth that we've experienced, I mean, the only reason we're on an upward projected economic growth path at all, I think, is because the Obama administration stopped doing anything about the economy and has just left us alone. But the problem is they didn't adjust the real stuff that would really help us, like the corporate tax rate still being the highest in the world. They're cutting back on energy production by discouraging coal, which should be used for electrical generation. So there's a lot of things. We could be doing 3, 4, 5% growth if they turn the economy loose.
Yeah, and you think about the fact, you kind of put oil to the side for a second, because we just finished up, for the most part, 90% of corporate earnings, companies have reported their earnings for the quarter, for the third quarter. And as it turns out, earnings have beat expectations by almost 5%. Now, as we got into the end of the quarter, there was a lot of people and strategists and economists thinking, at best, we're going to be break even. Now, we can't take energy out, because energy is obviously we're all very dependent on energy in our running our lives and our businesses. But if you think about what happened in the energy sector, with the price of crude, being cut basically in half. If we excluded energy unto itself with respect to corporate earnings, they would have likely been up anywhere, to say, from 7 to 8%. So that's pretty significant in spite of everything that we have to overcome. And so now it gets back to, and you take a look at the market, Friday, as you asked before. Well, with the jobs report, what happened? I mean, the market was fairly muted on Friday.
It was like 20.
It was nothing.
28 points or something.
But what happened was, now you have an opportunity to kind of think about it and work through the numbers over the weekend, and then you open up obviously overseas, and then the majority of those markets were down, and it came over here to the U.S. And it was I think it was one of the worst days that we've had in months.
But even so, 179.
It was not. I mean, in comparison,
17,000 points in the Dow.
S&P, Nasdaq.
You know, you're not talking big percentages.
1%.
Yeah,
1% move. But you see, here's what happens. The media has a tendency. You know, if you look, they focus all over, you know, the fact that the markets, you know, had a tough day yesterday. You're going to have days like that. But
well, everybody's got to work through the turbulence. People ask me questions all the time about the market, this and that, and I go, look, it's like a big rubber band. When you stretch it out like this and snap it back, it vibrates. And eventually the vibration slows down and it gets back to where it should be. And that's...
And I'll term that as volatility.
Yeah.
And you know, if you take a look at, you know, what happened with the VIX or the volatility index back in August, it spiked. It was up over 50%. You know, volatility has come back significantly. And as a result, now investors are not as fearful as they were several months ago. But the problem with the average retail investor, because they have gotten hurt a couple times over the last decade, is they are less anxious to invest in the equity markets. And I think at the end of the day, no matter what you do for a living, you know, capitalism is very, very important. And what drives capitalism, you know, for the most part, are the equity markets.
It's the only game in town.
And you know, we're not going to. We can talk about real estate. I'm certainly not an expert there. I mean, you chatted about it. I heard it on the way in as to what happened and why, and I think your points are very well taken. It was just a very, very bad time, you know, for all of us to live through. But it's like anything else. If you have the mindset and you understand this is hopefully not the future, but more of a short-term aberration, you should be okay.
And I would say this, as far as real estate is a great investment vehicle, but it takes a heck of a lot more knowledge than most people realize as far as making it pay off. And there's, unlike stock investors who can call someone like you, there's really no one out there to say, you shouldn't buy that. It's in the wrong location. You're overpaying. There's no one out there. There's really not that.
Yeah,
there's realtors, but they, you know, depending on whether they represent the buyer or the seller, their knowledge is going to be a little bit different than the kind of professionalism you bring to an investor who wants to.
Point very well taken. I can't begin to tell you the number of times that we chat with our clients and we actually talk them off of some of the ideas that they have, because when you think about it, you know, why do you want to buy that equity? You know,
right.
What is it that you're so tuned in to make you want to buy it? And oftentimes, you know, sort of like what I'll call reverse selling. You know, you tell me
you're
why
saving them from themselves.
You tell me why you want to do this.
Yeah, you're saving them from themselves. Anyway, we have to go to break right now, and we'll be back with Chuck Malamut in just a moment. Welcome back to Hurley in the Morning on WPG Talk Radio 1450 AM. We are talking with Chuck Malamut. And, Chuck, we have covered quite a bit of waterfront, but the big player in the room is always the Fed. And someone said to me, why are they so important? And I said, you know why? Because they manipulate our money supply and our interest rates. And then they asked me a very intuitive question. This is someone without economic training, without any financial background. They goes, well, why should we have artificial interest rates dictated by men in suits?
Men and women.
That's yeah. Oh, yeah. Well, I didn't correct them, but I was sort of paraphrasing, and yeah, that's what they said. Men in suits, and you know, the big thing is, when are they going to adjust the interest rates? Because at some point we have to return to normalcy. But our economy is so geared to these low interest rates that a lot of people are afraid that it'll have a very negative impact when they start the march to normalcy.
Well, if you remember the meeting that the Fed had, I believe it was in September, and the world got turned upside down when the Fed had intimated that they were going to make the move, but they weren't ready.
And we're talking about going from like 1.0 to 1.25 on the Fed funds.
Yeah, I mean, we're talking
a little microscopic move,
I think we're talking 25 basis points.
Right.
You know, there's a lot of different asset classes that will be impacted as a result of the Fed rate hike. I mean, I think it's pretty obvious for the average person to understand what has happened and why. And the question is, you know, at this point in time, what does the Fed do to you say, as you said, to make things more normal? I think the market's biggest fear is this when the process starts. And in all, you know, 45 days ago, everyone was convinced that at best, first quarter of next year.
I'm thinking first quarter.
March 2016. Now, I think now the Fed just doesn't look at one report, like the jobs report, to make a determination when to go. You know, we were pretty set before the August meltdown in the market that they would make a move prior in September. Then all bets were off. About 80% of those polled, the economists polled, were then thinking that they go first quarter 2016, 20% in December. Now it seems as if it's sort of 50-50 as you look at how the Fed futures trade and the fact that if you take a look at last week just all into itself, you had a decent equity market. You know, everything last week was up about 1%, but at the same time, what was happening is that your rates, your yields on your 10-year, the Treasury that we all follow, moved about 18 basis points higher, moved from a 2.15 to 2.33.
So they're moving on their own.
So they make that move, and then on the short-term side, the 2-year Treasuries also follow that similar path. So you're starting to see the market. Remember, the market is always a leading indicator as to where things are going to be. So I'm going to say it's about a 50-50 chance right now that they make a move in December.
Yeah. Now, on that, it should be pointed out that there's pluses and minuses. One of the pluses is the fact that your fixed income portion of your portfolio is going to start to return to a normal interest payout that you can actually measure and be significant. I love my statement when I get 1 penny interest.
Well, I mean, I think a 25 basis point movement is.
On my cash position, I get 1 penny interest a month.
I don't. You must have having a lot of money over in that account. Kurt, you have to have more than $100 in the account to get a little bit of interest.
Okay? Yeah.
But all kidding aside, you're easy to pick on too.
That's okay.
Harry's not so easy to pick on. What happens is it's not so much that it's 25 basis points. I think what the market is looking at is, okay, this is, as you said, that we're now starting to march to the more normalcy of the economy. So I have read and listened and watched, and they're not, it's not just a rate hike. You're probably going to see, that gradual stair step. But the Fed is going to be very, very cautious in any move they make, and they're going to be looking at every report that comes, because the last thing that could happen here is they derail the economy. I mean, it's the U.S. right now is sort of stands on its own island. Europe is
stagnant,
a little behind, but they're making significant progress. And you look at, the implementation of what was QE2 or QE multiple times here, the Draghi is now putting in place. I think that we are still focused on, the lack of growth as to what's happening in China, because we are a global economy, but we have proven that we are still at the forefront. and the leading country when it comes to global economics. There's no doubt about that.
Yeah, and one of the things that troubled me was that over the summer you had the spate of reports where they said China's now the world's biggest economy, which is false. We are trillions of dollars bigger than their economy, and somehow they had come up with some formula where they measured consumer purchasing power as a measure of whose economy was bigger, and somehow the average Chinese citizen had more purchasing power than Americans. Well, that was nuts to me.
If you take a look at the demise of their marketplace, of their equity markets, you remember obviously in the beginning of the year, the Chinese Shanghai equity market was up over 50%, and if you looked at the chart, it looked like a rocket ship.
Yeah, and they were trying to make the yuan a reserve currency.
And so what happened was, as you mentioned before, it's kind of volatility. It's like a rubber band. So anyway, their marketplace, obviously, for lack of better words, tanked. The good news is for us as non-Chinese citizens, we cannot buy that market. We can buy the Hang Seng, which is Hong Kong, which is fairly close. But what happened was, as evidenced in what the government tried to put in place to stimulate the market, they certainly do not have the skill sets that we have here, as evidenced in their fixes, so to speak. And I won't talk politics, but the one thing that's interesting is the fact that you don't go from communism or socialism to democracy overnight. It is a process that takes many, many years.
Well, the Communist Party hasn't given up power.
They have not, and as a result,
they still have central planning. They just have these little islands of capitalism that they authorize, and instead of letting them flourish, they want to manage them.
Well, and that was pretty obvious in the moves that they made, with the devaluation of the currency multiple times, and then their fixes with respect to the equity market. But in getting back, to the Fed, so
didn't Janet Yellen say last week we could go to a period of negative interest rates?
Well,
how does that work?
Well, if you take a look at what happened several months ago in Germany, in particular, their overnight money, you were putting your money on deposit at the bank. You put on whatever it be, $1, and you got to get your money out. You get back 98 or 99 cents. So there's a lot of discussion about deflation, and that would be I think somewhat disastrous to the economy. There has been multiple discussions with respect to a recession. I don't think we're close to that, as certainly is evidenced in the quarterly numbers that we just received. But I think what's important here that the listeners need to understand is that higher interest rates are going to obviously have a negative impact on fixed income that you own, but it's not so much all fixed income. If you're on the shorter end of the curve, the 2 to 5 years maturities, they will take more of a hit, so to speak, than your intermediate and longer term.
In the value, but you'll be actually, if you're coupon clipping, you'll get more.
Well, you'll get more money. If you're rolling, yeah. But,
Yeah.
And the thing is, if you own the actual security instead of a fund, and you hold that security to the end date, barring a credit risk or a meltdown of a particular company, you're going to get your principal back.
Right.
So I think that investors need to understand the nuances between a piece of fixed income and a fixed income mutual fund, because they are truly different, which takes me to the next point that we've talked about a couple times now. The year end's quickly approaching, and we are starting to see the capital gain distributions that the mutual funds will be distributing to their respective investors before year end. This is going to be a very, very challenging. It's been a challenging year for everyone. I think what's really going to be set investors maybe not on the wrong path, but get them very upset is the fact that you think about it, what we chatted about earlier today, we've made very little money in the equity markets. Some of these equity mutual funds by law are required to distribute all capital gains. Now, if you think about, as you mentioned,
it doesn't
before,
feel like what you're saying is it doesn't feel like capital gains, but you're going to get a report that says you had them.
Well, here's what happens as they trade
Right.
those accounts within a fund, and there's a gain, then they are obligated to pay that out to the shareholder. So you might have, and you're going to find it more obviously in your equity positions versus your fixed income, but what's going to happen is you might get anywhere from a 5 to 15% capital gain distribution. You made no money in the fund last year. So now you pay that phantom you have that phantom income that goes on your tax return. You pay the tax in April. Now, at the end of the day, it's okay because what it does is we adjust the basis from a tax perspective on your statement. So if you do sell that position, you pay the tax on the gain already. You're not going to pay tax a second time. But I think a lot of individual investors have no idea this is coming. And
New regulation?
No. It's just here's what happened in 2008 when the world ended. Everybody besieged the mutual fund, said, "Okay, sell me, get me out. It doesn't. I don't care, because 50% of something is better than 100% of nothing." I mean, that was the mindset.
And it did. It went from 14,000 to.
I mean, the S&P went to
6,000
666.
Yeah.
That awful day, March the 9th to be exact, but not that we're marking time in history. But
what a number.
So, yeah, what a number is right. But what happened was when all those funds were selling, they're selling at losses because they have to raise cash. And that cash then gets distributed to the shareholder that elected to sell. So now you can book your loss. You can hold that on your books, so to speak. You can take future capital gains and offset them to the losses that you have on the books of a respective fund. And what happened was, because we had a good run in the equity markets over the last several years, those losses have now been dissipated. They're gone. So now there's nothing on the books. If you take a gain, within a position, the fund is now obligated to pass that through to the investor. So that's
are the investors, just to be clear to the audience, are the investors going to be getting cash or just a report?
Well, you can take it a couple ways. Most people take it as reinvested dividends because if you take cash, the share value will decrease by the amount of the payout, which would ultimately create a quote a loss of capital, because now you're taking that capital, you're putting in the cash account, so to speak, within your brokerage account, we'll call it. I'm going to say that the great majority of investors reinvest capital gains and income in an equity fund and a balanced fund. A greater minority reinvest in a fixed income world. Take their capital gains as reinvestment, but take the monthly dividend as a check, because they want that income, as you mentioned to before about the saver. You need the income to maintain a lifestyle.
Right. Ever since interest rates went very low, the people who used to be able to depend on cash flow from their investments based on interest earned, that sort of went away for lots of people.
It has gone away for a lot of people, and I'm still perplexed how a retiree can actually manage with these very, very low or nominal interest rates at best.
Well, that's why they should be looking at dividend paying.
Well, but the problem, in a perfect world,
AAA rated corporate.
But even your good quality corporates, and there are I think there's maybe 2 or 3 that are quote AAA. I mean, anything above that triple B minus line and above is considered investment grade. The problem is that a lot of investors have taken a step out on that diving board, where they're chasing yield and buying riskier investments, which ultimately could come home to roost in the wrong way.
Yeah. And dividend-paying stocks, you have the risk of the value going up and down, which shakes them up.
Mm-hmm. So, again, it's a matter of being truly diversified and understanding what you own and why you own it.
Okay, we're going to go to break and then come back for our final segment up to the top of the hour. Welcome back to Hurley in the Morning. Kirk Conover sitting in today for Harry. 1450 AM, WPG Talk Radio, and I'm here with Chuck Malamut. We're discussing financial markets, the Fed, the global economy. It's interesting how much more emphasis on global markets that we have, say, just 20 years ago. I don't think we were that influenced by what happened overseas as we are now.
I'd even say a decade ago.
Yeah.
If you take a look, and I think a lot of it is, the speed of technology has a lot to do with it. The fact that we are a global economy now more so than we were, 10, 20, 30 years ago has a lot to do with it. And I think that when you take a look at why the Fed did not make the move back in September, it was because we are a global economy. And the fact that, what was happening in particular in China, I think the Fed got a little spooked. Now, the interesting thing about the Fed is that if you read or listen to the minutes, these decisions that they come to are not unanimous. You've had a number of Fed members that have been on board for quite some time, looking to increase rates.
I know the guy that's head of the St. Louis Federal Reserve Bank has been very outspoken.
And I think it's time. The Fed. We need to, as you mentioned before, we need to return to a more normal environment. And I don't think the average corporation that is constantly in the market looking to raise capital is going to be significantly impacted. I think the problem is once the Fed starts is to truly understand the number of moves and the timing of those moves. Do you go 25 basis points? I mean, think about when I remember years ago when Greenspan was in charge, and you'd look at the chart and it looked like a staircase.
Yep.
Where every meeting you would get a 25 basis point move and occasionally a 50 basis points. And I remember one meeting there was actually a 75 basis point movement. All in, I'm from what I'm reading, is you're talking 75 basis points. It'll be very, very measured, and it will take a number of meetings to get there. I don't think that the first 3 meetings of the year you go 25 basis points each meeting or whenever they start. I think they make the move and they sit back and they watch.
What's interesting to me about the Fed is the fact that the QE 1, 2, 3, which basically interjected cash into the economy, actually interjected cash into the banks, into the investment sector. They bought troubled assets, quote. They're still laying there in their portfolio, these mortgage-backed securities and things that they were buying to interject liquidity into the marketplace. When are they ever going to get rid of them? Who's going to buy them?
It's interesting as you kind of take that one step further. If you take a look at some companies that are very, very heavily weighted in real estate, and there's one in particular that I think you guys were I don't think you were chatting about this, maybe I heard it someplace else, that it's a local gaming company. It's a gaming company that has a very, very big local presence, but it trades on the New York Stock Exchange. It's not hard to figure out who they are. And what they did, in fact, is they took those troubled assets and they put them in a different
corporation.
Company. Yeah. And now the cleaner assets are in a different company. You're starting to see that develop over time. But I think, I know we're getting towards the end of our hour, and it went very, very quick, and I think you did a fine job moderating. I know Al did a good job over there. I know he's a little confused with a couple things that he's working through.
Missing cookies.
But we'll get through that at another time. But sort of off-the-air antics that happen. But I think that investors need to really take a step back and truly understand what they own and why they own it. If you go to the supermarket or go grocery shopping, I still can't figure out if you go grocery shopping or you go to the supermarket, but either one, they're kind of one and the same. You'll spend, I don't know how much time looking at brands going to the back and looking at the calorie count and the fat content and the carbs and the sugars and everything else that goes into it, you'll spend more time doing that than you will be analyzing an equity and why you should buy it.
Well, you know how you can avoid that. Just shop the perimeter of the supermarket.
I thought you'd say don't eat.
No, shop the perimeter of the supermarket where it's all fresh vegetables and meats. No calorie, nothing. You don't have to read anything. You just go, okay, it looks like a good piece of meat. Boom. That's a nice head of broccoli. Boom.
So maybe you come do my grocery shopping for my family.
It's healthier. Shop the perimeter of the supermarket.
So don't go into the middle.
No.
All right. So it sounds like we got the music cueing us off.
Anything you want to wrap up with, Chuck?
Kirk did a great job. Thanks for having us. Be patient and make certain you certainly understand and look at what's coming with your capital gains, because it could be ugly if you don't plan for it effectively.
Thank you, Chuck. As always, it's a pleasure.
Thanks, Kurt.
Kurt, we have someone coming up next, right?
Yeah.
Go ahead. You got to go through that disclaimer real quick.
Yep. Following program segment was paid for by Chuck Malamut, a financial advisor at Morgan Stanley. Information, views, and opinions expressed on this broadcast are those of Chuck Malamut, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of today's date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only.